All right.
Okay.
Everybody that just joined, I want to say thanks guys for being here. This is in the next 60 minutes. I'm basically going to go person by person and answer everyone's questions about deal analysis, market research, or using BrightInvestor better. This is designed to be a full value add session just to help everyone here as much as physically possible. And right now I was helping Brian on a fourplex you might want to pick up in this area. Okay. So this property just came on the market. We saw that it's well not even on the market yet. It's currently off market. It's coming on, and it's a four
Okay.
unit building that has been owned for almost 12 years. Okay, so the owner is local to Philly, so you can call this guy up. His name's Hugh. Hi Hugh, how you doing? So we can call up Hugh. He's the owner for about 12 years, but he put a loan on it for about $500,000. He has about $370,000 left in his mortgage. So it looks like he's planning to list it for 550. So it looks like he's around 200 grand in equity right now, which is compared to where he's trying to sell it for.
Okay.
Now, like I told you last night, we just updated Bright Investor last night and this morning with two new versions. So we just did that. We just made 50 improvements across the whole platform, which sales comps improvements as well. So looking at this product, right? We have a bunch of comps that are all multifamilies that are right on this area with a pretty solid estimated property value of about 535. So based on what we see the properties coming on market, it looks to be he's selling it for right around where it should be going for on a per square foot basis.
Okay.
Now on the rent comp side, I think they're all one bedroom apartments. Sorry, no, they're all two bedroom apartments because it said it was eight beds total.
8. Yes, sir.
So each one's gonna rent for about 1,200 to 1,250. And you plan to own or occupy one of them. Now, do you plan to live there by yourself or with a partner or a roommate or someone to rent the other bedroom?
Oh no, I was gonna be in the one unit by myself. I wasn't
Okay.
planning on.
So that's totally fine. So that means that we're going to be working with a gross income of $3,600. So just three units of
Okay.
1,200 each. And your landlord insurance policy is going to run you. Oh, this is an all brick building, right? We saw from the photos, this is a brick building. So for
Yeah.
example, brick buildings in today's market, you'll often see brick buildings being sold for 100 to $300,000 because that's their market value. But if you wanted to completely replace a brick building in today's market, it's often between 800,000 and 1.2 million. So oftentimes for cash flow purposes, folks will just insure properties like this for the actual cash value, which is what I do recommend when you have a brick building like this. Because
Okay.
really, if your cash flow can work an extra $100 a month, go for it. If not, no, absolutely no problem. So on this
Right.
deal analyzer, if you were to pick it up for the 549, they're planning to sell it for, and we have 3,600 bucks in total gross rents. We'll assume that you're managing it because you're living there. And how much do you plan to put down? 0%, right? With the VA loan?
Yeah, because the VA loan, yes, sir.
Okay. And what did you get pre-approved for on your interest rate?
I think it was like a 6.2, 6.3. I'm ballparking, just ball, yeah, something like that.
Perfect, 6.2. Okay. So for this property, right, it looks like you could live there and you're gonna basically lose about 860 a month just on your operations. And that's not including the fact that you're gonna be paying for your own electric and gas every month, which is
Right.
normally about $100 a month or so. And if we count for the fact that you don't want to pull off repairs, vacancy, and capex, because this is when you're not actually spending, you're just holding it back. In
Right.
reality, you could own or occupy this four family building and be out only about 230 a month. But
Okay.
you're not putting away any extra cash for repairs, vacancy, or capex, which maybe is
Right.
okay, but it's a little risky. But for you, you're basically living thought process here, right? Is you're living for 300 bucks a month. Your whatever
Right.
your rent is right now just dropped from 1,500 or 1,200 or 1,000 to 300
Right.
bucks a month to
Okay.
own or occupy this. I think it's a little tight. I would probably look to see, hey, can we get this thing for 500 grand and you're just breaking even.
Just breaking
You're
even.
just breaking even at 500 grand. So
Okay.
that's just from the deal perspective. So next thing, of course, right, we go to our appreciation and take a little look see and say, how is this area performing over time? Hopefully it's going well. I don't know, but that's what I'd be doing on. Okay, see, so this area is up about 80% over the past few years, which is solid. It's been growing. But I do want to point out to you, ever since interest rates started going up, this area has been pretty stagnant for home price growth.
Right.
And this is a pretty unique property. The fact that it's a four family with 8 bedrooms, which is really unique
Okay.
and which is really cool to see. Like it's a cool opportunity, but it is $550,000. And right now, the median home price is more around the mid 200s. So you're definitely buying a property that's far and above what most properties are trading for in this area in the residential space because
Okay.
it's a unique building. Now, what I do want to know is by clicking on asset type, if we check out this part of town, it's useful to know are there a lot of properties like that one, that multifamily, or are there basically all single family? Okay, so you got a ton of multifamily here. You got 15% of the market is 2, 3, and 4 units. And then most of the market is single family townhouse, like row houses.
Okay.
So there is a lot of multifamily in this area. So remember, my rule of thumb is 10%. If you're going to buy
Right, right,
multifamily
right.
somewhere, we want to see at least 10% of the market being multifamily. So for you, that's the process that I'd be looking at. That one, I think it's doable, but it's a little higher. If you're not going in with cash reserves for your repairs, vacancy, and capex, I'd be a little cautious. But if you're
Okay.
going in with the VA loan and you're getting 0% down, and we saw like your out of pocket costs are going to be 12 grand to buy that building. That's not bad. So if you're putting a little bit of cash down for that building, as far as like rehab and closing costs, and then you have a significant amount of cash like in the bank as reserves, it could make a pretty decent run up for owner occupancy. It's not a perfect one, but it's okay. And
Okay.
then I just want to double check the rent growth for a 2 bedroom in this area, and the rents are up 17%. So this makes me confident that over time you're going to be able to raise the rents in those 2 bedrooms and keep boosting your cash flow on a year-over-year basis because of the fact
Right.
this is going up.
Okay. That's a pretty good rundown. Okay.
So that's kind of like what I'm looking for. So it's not a perfect house hack. If you have cash reserves, it could make sense. I see the rent growth going up. You're buying definitely above the median for home values, but there is a lot of multifamily here. So it's
Okay.
something that for like this is one that for you, I would take this and I would add it to the list of just Brian potential deals. Like it's potential. It could work.
Okay.
I wouldn't call it a home run. So
Okay.
I would throw this on the potential deal list and then keep looking.
And keep looking. Okay.
Yep.
That's 4401 Ashburn Street. Okay. I appreciate that, man.
You got it. All right. Let's see. Any other questions in the chat? Please, if you guys have any questions, please drop them in the chat. I want this to be very communal, very much like, hey, what are you seeing? What do you need help with? How can I support you? So please put things in the chat. Let's see here. Kuno, I got a question from you. How can I analyze a market for Airbnb? Can you pick an example of how you'd identify a good city and narrow down on this? Sure, I can absolutely do that. Can you go ahead and unmute yourself and tell me a little bit more about your strategy and what you're looking for? Kuno, my friend, my brother from another mother, my sister from another mister. How we doing?
Hey, Donato, can you hear me?
There we go. Perfect. Okay, yeah, I can hear you.
All right, great. Yeah, now I'm just trying to at the beginning of my journey and trying to narrow down a market. I don't know, San Antonio or Austin.
Okay.
So
Okay.
and then the idea is to how can I use this tool to identify a good market, good location
Hmm.
within that market, for Airbnb, and
Sure.
maybe even narrow it down further by the kind of bedroom size and demand and kind of average prices and so on.
Let's do it. Okay. So the first thing I'm going to say, and this is my 100% bias, this is just my personal opinion. I think Airbnbs are a little risky right now. It's just my opinion. I always look at these kind of short-term and mid-term rental properties as will they at least break even as a long-term rental? So for you, I am going to operate in that same mentality because if you look at Airbnb's national statistics right about now, the best markets that they look at or that they operate across the country are averaging about 60 to 65% occupancy. 60 to 65% occupancy. And the average nightly rate across the US is about $150 per night. Now, that can vary wildly depending on the class of Airbnb you're going after. But when we do these numbers and we run it like this, I want you to know that's how we're going to analyze it. Because under no way, shape, or form am I ever going to recommend that we look at a property together where we assume that you're going to get 100% occupancy and $300 a night in Airbnb. I would like to go in with the worst case scenario kind of situation and make sure you feel confident. Just because I've seen other Airbnb investors go in too optimistically. Does that make sense?
Yeah, it does.
Okay. So looking at a market like Austin, one of the first things we're going to check out is appreciation for the entire city. Now, I'm going to ask right here, what's your price point? Like, what are we looking for as far as what you're trying to get into a house for?
Ideally between, anywhere between 3 and 500K.
3 and 500K. Okay. So what we're going to do here is one, everywhere in red has been losing the area. Look at that. This area has lost quite a 17% of its value over the last few years. This area is down 16%. Also, to the most expensive neighborhood in town, they were there for 1.1 and 1.8 million dollars. So anywhere in red has been losing value. Okay, easy. Now, also, I want to point this out to you, right? On the market saw massive gains during COVID. Like home prices literally went 575,000 to over 900 grand. Since then, there's been quite a correction down to around 755. In fact, here's our trends right here. They have been going down, which means I want to make sure that we're putting you in a part of town where we're buying below median home price for the city, while also buying an area that meets your price point, while also finding an area that's been growing. So by going over the zip codes here, we're looking for 3 to 500 grand. Okay, boom. Median home price about $450,000 as of July. It's up about 44% in growth. 425, 399. Okay. So both of these areas have homes that are in our price point, plus their appreciation numbers are 54% and 64% are higher than the city's average of 47. So long story short, these areas have homes that are in your price range and appreciating faster than the rest of the city overall. So right off the cuff, these spots stand out to me as areas that I might want to be interested in. Does that make sense how I did that?
It does, but I guess one question would be, eh, does it also imply that these have already gotten higher, meaning more expensive than the others? So the potential for further appreciation might be a little bit less in those areas as compared to the ones that didn't go as high. You know what I mean? Like the other way, so the flip question.
Yeah, so the way I look at that is when the city's median is 700,000 and this area is at $450,000, compared to the rest of the city, there's almost a $250 to $300,000 gap between where most properties are selling for. So that's why I'm looking at this area advantageously, because this is a spot in town where compared to what most properties are going for across the entire city of Austin, there's still a lot of room to grow. So that's why I don't recommend going somewhere like this, where, hey, home prices are over 1.5 million. One, it's very expensive, but two, we also see that more expensive markets like this are also the most prone to clients like these areas did. Did that help answer that question a little bit?
Yeah, it does.
So the next thing I'm going to do is I'm looking at this area. I'm going to drag my little pin over here and drop it in that zip code that I want to investigate. And I'm going to do population. So we're looking at population for this zip code. Reason I'm doing this is because I just want to see, you know, is the area trending up or trending down? Now for Airbnbs, right, a lot of your clientele are going to be people coming from out of state or out of market to come be here. All we want to know is that if you're going to be renting and buying a property here, more population is more demand. And where there's more demand, the city will put more resources behind improving the area. And it's going to be easier for you over time to rent this out to more people, as opposed to putting an Airbnb in a part of town where people are actively leaving. So the area is trending up, which is good to see. The next thing I'm going to look at is income. Generally speaking, I'm going to go ahead and look up to current data levels. When we're looking for places to do Airbnbs, higher income is better. And this area is definitely growing in income. So national median area is around $68,000, $69,000 for income, and it's up over 21%. My rule of thumb is about 15%. So anything over 15% is really growing in the income space, and this one definitely is. So I'm seeing a lot of opportunity here as far as over time being able to raise rents and attract a more higher income clientele to your property. Now, coming to what kinds of properties you should buy, I like to use the example of fishing in a stocked lake. I think I talked to Brian about this in our call the other day. But if you're looking for a multifamily in a certain part of town, we got to make sure they're actually multifamily for you to buy. So, clicking on asset types for this zip code, the majority of properties are, oh, interesting, 20 plus unit apartment complexes. So this is a big multifamily part of town. Lots of apartment complexes. You've got tons of duplexes, tons of fourplexes, tons of 5 to 10 units, tons of 10 to 20 units, and a lot of big stuff as well. Which means if you bought a single family house or a 2 or 3, 4 family, there's a lot of opportunity for you to graduate into bigger and bigger multifamily here. Does that make sense?
Can you elaborate on the last sentence, like graduate to a bigger multifamily from a 2 unit?
Yeah. So my rule of thumb is like with Brian, if you're trying to target a certain type of asset, you should at least 10% of the market should be that asset. So if you want to buy 2, 3, and 4
Okay.
unit buildings, then 2, 3, and 4 unit buildings should make up 10%. So the 2 units make up about 7%, and the 3 and 4 units make up about 7%. So that means 2, 3, and 4 unit buildings make up about 14% of the market. That means there's enough available inventory for it to be worth your time looking for multifamily
Okay.
in this area.
Understood.
And all I'm saying here is like, hey, if you buy a couple of properties and you start crushing it, and you eventually say, you know what, I want to level up and I want to start buying more multifamily or a little bit bigger multifamily. There is a lot of 5 to 9 unit buildings and 10 to 20 unit buildings all in this area. So that's all I'm saying by graduation. There's a big diversity of asset types. So the next thing we're going to look at is our bedroom count. If we're going to be buying properties nearby, how many bedrooms is common? A lot of 2 bedrooms and 3 bedrooms. So the properties that we should be looking for are 2 and 3 bedroom properties in this area. Pretty much ignore the 1s and the 5s. That's our demographic. 2 to 3 bedroom, single to multifamily in this part of town. So now we need to start looking at opportunities. So let's go ahead and look for deals. And let's look for an off-market single family property that's going to be underneath our price range. And ideally it's going to be just in this zip code that we're looking at. And we know we want it to have at least 2 bedrooms because that's we saw that most of the assets are in this area. Now, we also want to find a seller that's motivated to sell. So let's find someone that has a lot of equity, that's an absentee owner, which means they're a landlord, so they don't live in the property that they own. And let's also find someone that's been owning, let's see here. Yeah, that looks good. That looks good to me. So we'll search properties. All right, we got 52 properties that meet our criteria in this area. So now's the time we start looking at them and take a look at, say, this one. So we got a property here. Guy's owned it for a couple of years, and he has no loan on it. So he's an absentee owner, free and clear with high equity. So if you're going to make an offer for this deal, and you want to try to make a lower priced offer, there's no mortgage that he has to pay off that's in the back of his mind. The guy lives in Cypress, Texas. We can click this button and get his phone number and give him a phone call. And now we want to see what this property is probably worth. So based off a bunch of comps we have in this area, and I personally like to filter it by build year. So we only look at properties that are similar vintage and also look at properties that are similar bedroom counts and similar bath counts. and similar size. I like to get specific. That's just me. By turning on these filters, we have found only properties that are exactly 3 bedrooms, exactly 2 bathrooms, were built within the same 10-year period, and all within 15% of the same size. And this property looks to be worth about $333,000, which is really close to what our initial estimate was on the valuation. For you, like I talked about, I never recommend buying a short-term rental if it doesn't at least break even as a long-term. A long-term property in this area will rent for about $2,400. And if you want a list of comps, just click this button and we'll get those comps to you. And your insurance is going to run you about $83 a month for your landlord policy. So now let's run the numbers on this deal. If you were to buy this property for the estimated value of $333,000, and you had to do it as a long-term rental, Kunal, do you plan to have a property manager or manage it yourself?
Likely a property manager.
Okay. So if you had to long-term rent this property out with a property manager at today's interest rates, if you put 20% down, all things concluded, right? You're probably going to be losing a couple $100 a month. Now, if we take off repairs and vacancy and CapEx, so you're not actually spending that money, you're around break even. You're around break even as a long-term rental. And do you see how I'm getting there when I'm
Yeah.
going this way? Okay.
Yeah.
Now let's talk about short-term rental. Now, for folks who are here, you guys know that we're coming out with a co-living or pad split calculator and a BRRRR calculator and a seller finance calculator. So those will be coming out soon. Let's talk short-term rental. So I type in my purchase price, $333. If we do the average nightly rate of $150 and we use an average vacancy of 45%, maybe you want to get aggressive and say, you know what, we're going to do 35% vacancy, and you have a property manager managing it, this deal at these rates would lose you about $1,000 a month. So we can always go to a place like Airbnb and take a look-see at the reason we don't bring Airbnb data like live on the platforms is there's other platforms that do that. It's all they do, and it's super easy for us to just check those things out. We were looking at Austin. Whoops. And actually, we were looking at what zip code? We are in 78758. Let's get specific. 78758. Boom. I don't care. You pull open this zip code. Okay, in this zip code, right? This actual area. Okay, look at that. They're cutting $53 a night, $85 a night, $123 a night, $39 a night, $129, $55, $95. You see, so it's even lower than our $150 a night estimation based off national averages. So if we're looking at a property that we actually want to operate here, and we want to be even more conservative, call it $90 a month, 90 to $100 a night. I think this would be a horrible investment. Horrible. Would not recommend. Instead, I might look at Furnish Finder and take a look at what a midterm rental would rent for here. Maybe I get to, and this we work with Furnish Finder to bring these numbers in, but around $2,300. So this property, as a long-term, barely breaks even. Short-term rental definitely doesn't make sense. And as a midterm rental, that, in a nutshell, is how I'm taking opportunities, looking at markets, looking at zip codes, and then looking at properties within them to see if they make sense. And so kind of like with Brian, if you're looking at deals off market and you want to pull them off BrightInvestor, awesome. Or if you're on Zillow and I understand a lot of people still, even though you can find on-market properties in BrightInvestor, a lot of folks still use Zillow. You're not going to hurt my feelings. I'll cry about it tonight, but that's okay. I understand. And we're doing 78758. Let's say you're looking for properties in this area and you want to see something that works and you're looking for, say, a single family house. We can take these properties like this one. Say, hey, I want my agent, maybe this agent sends you a deal, Kunal, and they're telling you it's a great Airbnb and you're rightfully hesitant because I think agents are fine, but their only job is to sell you a property, not sell you a deal. But the best agents have your personal goals at heart, and so they'll care about you and they put your goals ahead of them, which is why they're so valuable. But let's say someone sends you a deal, you know nothing about it. That's where we just take the address and pop it in here, and then we can run the numbers again and open up those details. We see that it's active. It's a high equity owner. Pop right over to my deal analyzer. Short-term rental. Oh, okay, yeah. At 150 a night, at 45% vacancy, does not work. As a long-term rental, because this property would rent for over $4,000 a month, this property makes a little bit of sense. As a midterm rental, probably not. So in about 15 seconds there, we've run our numbers on this deal. Now, let's assume that Airbnb looked really good and the numbers worked out. This is how you make sure that it's in the right street of that area. So we look at things like franchises. Specifically, Airbnbs are all about convenience and in proximity to really attractive, like wineries or sports arenas or restaurants or things of that nature. So that's when I say, hey, where are all the Targets nearby? Where are the Chick-fil-A's? Okay, where are the Whole Food markets and the Trader Joe's and the Lululemons, the shopping district, right? And so when I'm looking at this, I'm saying, okay, great. A lot of those high income franchises that cater to a bigger demographic are up here towards that north side. So for someone like yourself, closer you can be to those convenient locations, the better. The next thing I'm going to do, once I layer that, is pop open the crime. So if we're going to be investing here, let's make sure we're not buying an Airbnb in a really high crime street. And take a look at this crime heat map here. So looking at this map, all those areas that are in green are dark crime spots. And so all we're looking at to see is, you know what? If we're looking at these areas, most of the lower crime spots are more towards this North Austin. And of course, we can always zoom in on these crime maps and see the individual crime pins. And so you might say, hey, the numbers on this Airbnb look really good, but it's in a higher crime area. I don't want to make that investment. I've taken a lot of time there. Kunal, does that help a little bit on your journey for figuring out how you can find markets, areas, analyze deals, and find deals for your specific use case of Airbnb? Pause for effect. Dramatic pause. Kunal, was that helpful for you?
Absolutely. Yeah.
Perfect. Okay.
Definitely.
I
Thanks so
appreciate
much.
it. Yeah, you got it. All right. Let's see.
Hey,
Any other questions? Oh, yeah, go ahead.
one really quick question, Donato. Even though, again, I put it into the chat a second ago about AirDNA,
Mhm.
and I really don't look at short term, but that's something where um, the AirDNA platform basically is
Yep.
almost kind of like a data aggregator, it sounds like. Is that
Mhm.
something that BrightInvestor incorporates into the data, or was it just um, data that's coming straight from Airbnb?
So for the estimators, we work with Airbnb to pull the averages for our nightly rates and occupancy numbers.
Okay.
Airbnb does have the option to bring more specific vacancy and occupancy, which they have a connection that we've worked with them a bit on to be able to basically connect to directly. We don't really prioritize it because it is changing a lot right now. And we find that a lot of the folks who are in our space are using leveraging BrightInvestor are focusing on long-term rental, mid-term rental, co-living, and multifamily. And more folks are going more towards those strategies and less towards short-term rentals. So we haven't pursued a further partnership with them to say bring more live Airbnbs in the product. We've tried it in the past. People just weren't really using it. So there's always opportunities to double down on those partnerships, but that's something I would do more so um, if I had a lot of people looking for specifically short-term rentals on the platform.
Okay. Yeah, no, that makes sense. Like I said, in basically to that point, even though again, not really something I'm focusing on, but was just something that because of that sort of longer term trend away from
Yeah.
Airbnb, was more curious than anything. So definitely appreciate it.
Yeah. Yeah, absolutely. That's what I've seen a lot. Most folks that I'm looking at that I work with now who are looking for properties find that the short-term rental game is a little labor intensive. And unless you're looking to set up that business of operating a short-term rental, it can be a little more than folks are willing to work on, especially if they're getting into it for the first time, maybe have a W-2 job, maybe have a full-time family. It does really require a lot more active management. And with
Yeah.
more and more areas, with such an oversupply, I'll use the word. I know what I'm saying here, oversupply, but I'll with such a large supply of short-term rentals on the market, and we're seeing some declining nightly rates for when people tell me their goal is financial freedom or looking to buy a couple of properties to park money in, they don't want to worry about it, or they're looking to get more like conservative on their approach to investing. It's something where I don't really push a lot of people towards. Moreover, but that's my 2 cents. So let me go ahead and open the floor for more questions. Thanks, Chester, for the question. Appreciate it. Um, Anyone else have a question about maybe do you have a deal under contract you're looking for me to take a look at? Do you have a market you're looking at? Or do you have a question about BrightInvestor, a problem you were having, or a feature that you'd love to see added in? For those of you who did join a little bit later, we did just release a new version last night. You'll be getting an email about it here soon, but we just added a new version this morning and last night, upgrading the platform with some new stuff. I think it's like our second release in the last week. So we're churning and burning off your guys' feedback a lot right now, which is exciting. Any questions? I'm going to call people up by name I haven't heard. So Jason, I haven't heard from you yet. Uh,
Um, if nobody else has any questions, I'm just thinking about looking into South Bend, Indiana. At
okay,
units. I haven't looked at it at all, so I mean, if someone else has a question, I don't want to waste a lot of time on it.
no problem. How about I do this? Let me do a quick rundown of kind of 1, 2, 3 steps that I recommend you go through, and then you can recreate them a little bit later today when you have some time in your computer.
Okay, perfect.
Okay. So South Bend, real quick, what's your strategy? What are you hoping to get out of it?
Multifamily, long-term investment, buy and hold.
Lot multifamily. Okay, great. First thing we're going to do. Let's go ahead. Asset type, city by zip code. How much multifamily is there? Okay, about 3.3% and 1 point. That's about 5%. So about 5% of the market is 2 to 3, 4 unit buildings. My rule of thumb is 10%. Not a ton here overall. So it's a lower multifamily market. So that's the first thing I'm looking at here. Doesn't necessarily mean we can't find any, but it's going to be harder. So what we can do, you see these zip codes that have dark green, these darker ones. So these are the areas that have more housing units, which means these are the areas that are more likely to have more duplexes and such. So I'm going to grab my little pin and pop over here and then do asset type for just this zip code and see if my numbers change at all. Yeah, okay, a lot more fourplexes are over here. A lot more 3 and 4 families are over here. We're still only at about 6% or 7% of the market for multifamily. I'm willing to try if you are, but that's one of the first things I'm going to look at overall is what's this look like? Now, same thing I'm going to do is appreciation, just like always. Whatever your price range is for the property, maybe it's 200, 300, 100, 400, whatever your price range is. Do you have a number at the top of your head?
Usually, well, here in Chicago, I do like between 400 and 600.
Okay,
Like I
400,
said,
600.
this is a new market to me, which might not be good for multifamily. It's looking like.
And that's totally that's why we put BrightInvestor together so that you can what in 10 seconds we can say yes or no. And that's why we're here is to help you do that process quickly. Now, I look at a lot of markets, guys. I have never seen a market that's appreciated that fast on the past 7 years. That is insane. Absolutely insane.
That's
171% growth in home prices, an average of 16% per year appreciation over the last 7 years. That's bonkers. Home prices went from an average of 89,000 to 244. Now, to be clear, they did pull back. It went from 320,000 down to 210. They lost 30% in their value in just, what is that, March 2023 to about March 2024. So in 1 year, they lost 30% of their value, which sucks. But it also means that we want to be looking at properties that are below that median so we can avoid any massive reductions in value. So for you, buying between 400 and 600, you're going to have no problem out here. No problem. I would recommend not paying 400 grand for anything in this area. But I would look for those areas where we're like, say, oh, this one or this one, where home prices are up 200% here over the last 7 years. And the median house price is about 150. So I'm going to drag my little button, pick this area out, do population, and check out this part of town for population growth. And it's growing. So it's up about 3% over the past few years. Just so solid. It's growing. And the next thing I'm going to do is look at that income and rent growth, the type of properties we're looking at. Then we'll go ahead and do our deal search. So if we're looking for our off-market multifamily properties that are going to be ideally no more than 200,000, because we saw the median house price in this area is about 150. And we say, let's find just those properties in this area. We know there aren't a ton of them, but there are at least 74 that we can start looking at.
Wow, a lot more than I thought were going to pop up.
Yeah. Now, remember, like 4% of the market is still about a couple hundred units worth of small multifamily. So it's not a ton of opportunity, but there are some. And I want to be clear, I didn't put on any seller motivation filters. So if you want to find someone that has a lot of equity and is also a landlord, that 74 goes to 43. Still possible, but we just cut our pool in half. But Jason, that's the process that I go through with you to really quick figure out what part of South Bend makes sense, and hopefully it's answered a couple of your questions.
Yes, that's great. Thank you very much. Appreciate it.
Absolutely. All right. Any other questions? Next person. I'm just gonna go down my list. First from Brian, work with Jason, work with Kana, work with Chester. Nick, how you doing, Nick? I saw you join on Wednesday's office hours for like 20 seconds, and you left, calling you out. I was hoping to chit chat with you then. But how you doing? My man, Nick Wilson. Can I help you with anything on real estate investing, BrightInvestor, or looking for markets or deals? Might be away from his microphone, which would make this really funny. Yes, no, maybe so. Okay, moving on. Brittany Lawson, how you doing? Hey, I have a meeting with you in like 30 minutes.
So that's why I was saving my questions because we have an actual meeting. So I was trying to give everybody an opportunity to
Perfect.
ask their questions.
Okay, great. Well, I appreciate that. Thank you. Very kind. And I'll go ahead and PC questions that I can help you with. Looking for markets, looking for deal analysis, anything of that nature I can help with while we have you here today. Going once, going twice, and sold. Okay, not a problem. Oh, got a chat here. Oh, here we go. Help me with Dayton, Ohio. All right, let's talk with Dayton, Ohio. All right. So just like always, first step, I'm looking at appreciation. So appreciation, I do this whole city by zip code. All we're going to do here is look which areas are growing, which areas have the price point that you want to invest in. So I don't know what your price point is, but let's say that it's 200 grand. What I'm looking for is the fact that this area, do you see? I see how consistently up and to the right this market has been over the past few years. Like we compared to the South Bend, which had a 30% reduction. This area did have a bit of a pullback, but now it's back up again. This area is definitely up and to the right. So Dayton's definitely attractive. It's appreciating about 11% per year. Almost every single zip code is up in value for the past few years, which is great. And if we're looking for parts of town that make sense to invest in, say like this one, this area's home price is about 200 grand, appreciate about 97%. could make a lot of sense to invest here. So I'm just going to take my pin and I do the same thing as always with my population. Get an idea of how has this area been going up in population growth. It's up. It's not. It's down about 7%. Right off the cuff, not too keenly interested in that. My rule of thumb is you want to see 5% growth over the last 5 years or 1% every year. The fact that this area is down about 7%, definitely not attractive to me. So I'd probably just ignore this spot right away and go back to looking at which parts of town for the entire city actually have the right population growth that I'm looking for. So any parts of town, as a reminder, that are losing people year over year for the past couple of years is a decline in your potential customer base. What we want to do is avoid putting your properties in areas where people are actively leaving. That's fewer people you can sell your houses to, fewer people that you can rent them to, and cities don't tend to reinvest dollars in areas that are actively declining. Instead, they try to enrich areas that people are already moving to. And when we look at a population map of Dayton, everything you see in salmon or red has actually been losing people, just about. So red, 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 red. Ours is like a little bit salmonish, pinkish color. So we're looking at spots that actually been gaining population. Spots like down here, this area is up 24%. It's a lot more attractive. Areas over here, up 4%. Areas over here, 13%. We're looking for this area, which is up 56%. This is much more attractive as far as the population growth perspective. So this is where I might come over here and say, let's look at Southeast Dayton. Now I'm looking at Southeast Dayton. Let's say we're looking for a 2-bedroom house or a 3-bedroom house. This is when we pop open that rent growth and get an idea on how quickly are rents going up in this area. In this case, 2-bedroom rents are going up 28%. That's really positive. And this, like I've looked at with Jason and Brian and other folks on here today, once we have a pretty good idea of what part of town is appreciating, the growing population, and has growing rents, that we can go step by step on looking at incomes, what kind of assets are there, and then looking at the street by street level before looking for deals. PC, does that help a little bit on looking at Dayton, Ohio? Maybe a little bit. Yes. Yeah. Perfect. Awesome. Okay. Good to hear. All right, Chester, you got another question. Go for it.
Okay, yeah, this was similar to the franchises layer. Simply the best, I mean, I kind of typed it out a little bit, but it's basically the main gist of it is like major employers as almost kind of a quote unquote at a glance of like, for example, using Dayton here with uh Wright-Patterson Air Force Base, I believe it is, nearby. So there's going to be, your defense contractors like your General Dynamics, Boeing, et cetera, so on and so forth. Like, is there a way to get or add, I should say, like a layer to be able to say, like, hey, major employers with, and I think a couple, what was it, like, something up to 1,000 employees or, 10,000 employees or whatever the case may be in that for whatever offices in that area, similar to that franchise layer where it's like, hey, 123 Main Street is the address, and then, that would be a little bit tougher, I think, because one, there's um the fact that like people will be distributed basically throughout the US, maybe not all concentrated in an office. And then there's also the work from home uh uh I don't know how to better describe it other than just like, people can work from home. So it may not necessarily mean like all, 5,000 or 10,000 or however many people are in that particular office, but something
Yeah.
along the lines where it's just like, hey, there are at least considerations of major employers nearby to, and I think Wright-Patterson is like a little bit east, uh, Let's see, maybe a little bit further north slightly, because I know it's nearby.
Okay.
Oh, there it is, right there.
Okay, there, yeah, right there. So this is right, Patterson. Yeah. So, you kind of nailed it on the head as far as employers. So, what the main thing I do is like most cities will have a lot of their corporate offices or employee centers in some part of town. And then what I try to do is then look at where the population is growing the fastest. Because that usually means that people are commuting in. Like a lot of people, even you guys can think about this in your day-to-day lives. A lot of folks will commute over to the office. Folks will prioritize living near good school districts, low crime area with the neighborhoods they want to be in over being, right next to work. They kind of balance those two things. Like people are willing to drive maybe 10 minutes or 20 minutes if it means a better area. So what I typically do then for that is I'll look at where's the population growth. And then when I can do those franchises and say, hey, in this area, where are the Whole Foods or the Trader Joe's, if there are any, the Chick-fil-A's, the Targets, the Starbucks, where are these people basically deploying their capital for franchises? That's what I'm going to leverage to see where are the employees likely moving to. So it's possible for me to take a look and see if we could add something where here's where the employers are. But for example, for my investing purposes, the only value that I would get off of knowing who specifically is employing people is if they're announcing major expansion, which is great, which could bring more jobs to the area. And if I'm going to say maybe buy land somewhere and hope that they come buy my land as a part of their development project. But for that, I'd usually just click jobs and we upgraded this now, so it's automatic. This is where I'm looking to say, hey, the job market here is up about 3% over the past decade. The current job market sits at about 380,000 jobs. And the biggest industries are education, health, trade, and government. So when we see that, knowing that my rule of thumb is 10% growth over 10 years, I know that Dayton really hasn't seen a pretty big jump in job growth and it's not booming. So this tells me that there's no major employer, there's no major expansion currently happening as far as the job market is concerned for this part of town, which just makes it a little more, I guess, non-reliant on where the employers actually are. That's my 2 cents.
Okay. Yeah, I know there are like a couple of industry reports where
Mhm.
oh goodness, I cannot remember the name. Oh, Intel. I think Intel is
Yep.
moving. It's either right outside of Dayton or right outside of Columbus, but Columbus isn't too far from Dayton. So I know
Yeah, it's pretty close.
they're planning on putting something either slightly east of Columbus or in between Columbus and Dayton as like a, I don't want to call it like expansion plant, but basically like it's
Yep.
going to be some sort of like plant where they're going to either fabricate or develop chips,
Mhm.
computer chips. I can't remember the exact word, but basically that is something that's coming online. And like you said, it's kind of tough to be able to put that into the like a holistic model without
Mhm.
like being able to say, okay, hey, we know for sure that this is like on its way. I forget what the name of the report is that I looked at, but like that was something where I was talking with like a few other investors and they were uh part of basically like a bank.
Okay.
What's the word I'm going to use? Like basically like they work for banks and they get like something called the industry and trends report, and that's where they found out, hey, here's where capital's moving, and the reason behind it is, so that's when they found out, hey, Intel is looking to move to that, Columbus Dayton area to um build that chip factory. So
Cool. I could definitely take a look at things like that and see if it's something that's possible for us.
okay, yeah, like I said,
Perfect.
and it doesn't even need to be something like super duper granular, but just something along the
Mhm.
lines of like, hey, there's at least enough data here to be able to further validate everything that you're already
Sure.
seeing so that, like you said, some businesses may have been, you know, in business for a while, but may be ready to pull out or things like that. And like you see the population growth in a negative direction,
Right.
things like that. So
Good idea. That's a good idea. Oh, for one thing, I do want to point out to folks, as a reminder, since we did launch a new version this morning, making sure you guys are aware of some of the new tips and new features that you guys have. Whenever you have a property report that you generate for a deal you like, and you're sending it to someone, I want to point out, if you go to your listen report section, there's now this little gear icon. When you click this gear icon, this shows up. And so what this means is any part of the property report that you don't want someone else to have access to, you can now turn off. So Brian, if you're like sending your deal over to a lender or sending it over to someone you're partnering with, or maybe Brittany's sending a deal out to someone and maybe she's getting to know them, she wants to keep things in private for a little while, you can turn off, say, the owner. Maybe you don't want the person to know the name and phone number of the person of the deal that you're working on. Maybe you don't want them to see all your numbers. Maybe you don't want them to see the notes you took. You can basically turn off any section for that report, and it will basically make it blank so that you can send it to anybody and protect whatever information that you want. So that is brand new that you could do. I just want to point that out to you guys. And I do want to test something against you guys as well. One feature we've had a lot of requests for is on those Bright reports, being able to download them as a PDF and make them printable. So we've gotten folks are out there who are going into meetings or meeting up with people. They want to be able to print or download things as PDFs. So we are going to be adding in the ability to download those reports as PDFs so you guys can use them in more creative ways. But wanted to give you guys that update while you're sitting here. You guys took the time out of your morning to come learn more. So I want to give you guys a little sneak peek of some things that we're working on coming out.
nice.
Perfect. Any other questions, comments, or support that I can offer while we're here this morning? As a reminder, moving forward, we're going to be doing these every Wednesday night at 6 p.m. Pacific and every Saturday at 10 a.m. Pacific. This every week, as long as you guys are rocking with BrightInvestor, you're going to have full access to me twice a week, every week, just to help you out wherever you're going, whether it's deal review or market review. So want to make sure you guys keep getting those emails and here to support you however I can. You have any suggestions on times or extra things that would be valuable to go over during these sessions, please just shoot me an email and let me know. And I'm going to make one last call out to Nick. I hadn't heard from him earlier, but I just want to make sure if he's here, I get the opportunity to answer any questions if he has them. If not, no problem, Nick. I'll just silently pine for your attention next week, and we'll talk then. Whenever you want to go ahead and want to unmute. Not seeing unmuting, no problem. And then Sarah, I saw that you joined recently. Want to make sure I give you a chance to ask some questions in the last few minutes here.
Hey, Donato. Thanks. I am taking everything in for now. I'll probably join one of the later meetings and have like probably a list together.
No problem.
But I joined a little bit late today, so I don't want you to have to go over something that you already may have discussed. So
no problem. I'm also happy to let you guys know there is something new that we're trying out. Basically, I found that a lot of you guys would value if I showed you what markets I like, if you're looking for markets to invest in. So we have built a easier kind of market finder where when you're in BrightInvestor, I think it's going to come out next week. It's going to ask you about 5 different questions about what you prioritize as far as appreciation or cash flow or single family or multifamily. And then I'm going to give you 3 pre-chosen markets that meet that criteria that I've personally looked into. So my goal is to help everyone here. If you're looking to expand and looking to go somewhere and you want to know what areas I've looked into, you're all going to have basically a super fast, easy way to do that. So I care. That's why I'm doing it. But you guys will see that this coming week. Jason, I want to say thank you. It's great you're doing this for us. Absolutely. Absolutely. Brittany, absolutely. We'll get those out for you. This is my 2 cents. It's becoming another just little time to talk with Nato. I know a lot of folks in here are in, paid mentorship groups or communities or masterminds, or maybe aren't in them because you're concerned about things like getting the value you need out of it. My goal with Bright Investor has always been to make your guys' jobs easier with real estate investing. And my goal here is a lot of people don't get the one-on-one attention they need from current education and communities. So I want you guys to have both the tool to be able to master real estate investing and buy deal after deal for yourself or your clients or your friends. But I also want you to have the one-on-one support and education and kind of apprenticeship, my word for it, of one-on-one support or this kind of small group support to be able to keep growing and apply what you're learning. So that's my big goal with what we're doing here. And so, Jason, if it helps, that's absolutely my 100% goal. PC, can you tell us how do you invest out of state in terms of finding people like property managers? Yeah, absolutely. So when I'm looking at a state at a property, if it's on market and there's a realtor or broker associated, I'll ask them for a PM recommendation. If I don't know the area that well, let's say I'm going into Dallas, or you were looking in Dayton, so I'll use your example directly. When I'm looking at Dayton, Ohio, one of the first things I'm just going to do is pop up Dayton, Ohio property managers. And when I find that list and I have these things pulled up, I want to get a curated list of a couple of them based off review count. So if I have a referral, I'll call them first. Otherwise, like this one that has a lot of reviews, good amount of stars. What I'm looking for once I hit that website is that they have experience in my specific kind of property. So for example, like these guys, they do homeowner association, multifamily, and residential real estate. Okay. They have a lot of different experience, and I'm looking to see what kinds of basically properties they've experienced mentoring. So some of the questions that I ask, and I'll put these in the chat. What I will do is I'll ask, how many doors do they have? How many doors do they manage? I'll ask, is their repair and maintenance in-house or outsourced? I'll also ask questions like what type of properties they normally manage. So when it comes to like strategy and also asset, like strategy and like A or B or C properties, I want to know what their markup is for fees and hourly rates and materials. And I want to know what kind of eviction experience they have in this area. And if they have any guarantees on if they place a tenant that is evicted, do they guarantee they'll replace it? And I want to know what their renewal fees are on contracts, what their average occupancy is across their portfolio. And I'm going to ask questions such as, do they give their current clients first dibs on properties? So basically, if they have a client that's looking to sell out of one of their current properties, will they send that property out to their existing client base to ask if they want to buy it for anybody else? I've definitely thought about bringing property management searching inside of BrightInvestor. I do know that Bigger Pockets has a pretty decent property management finding tool already, and it's pretty quick. So I'm tinkering around with how I would do that directly inside of BrightInvestor. I think it's possible. In the future, I'd love to have property management companies basically compete to be listed in BrightInvestor as like we've personally vetted them, and we have a lot of highly recommended folks that have used them. And then whenever you have a property, and let's say you find like a deal, and I'm just going to pick a deal here. My ultimate goal would be you click a property, and then one of these tabs says local pros. And then in there would be a property management company, contractors, and title company, and then a lending company that all would be willing to work with you on that deal. That's what I'd love to be able to do. So that's my That's my answer to that. So I got a lot of ideas.
Donato, I'm just and again, sorry if you already went over this, but it would
Yeah,
be
go ahead.
if you could maybe tell us a little bit about your own like investor experience and what your strategies have been and what draws you into certain markets over others. I just think that would be really interesting to hear and probably a good value add for at least for myself.
Yeah, absolutely. So my journey as an investor started when I was I'll stop sharing my screen and just maximize my face so you guys can see that. Um, Started when I was in college. I got into wholesaling real estate, and I did that for about a year. Got some things under contract. Had a property under contract that's going to make me $25,000 in assignments. But the woman who owned the property, it was her adult son that lived there from across no problem, Chester. See you later. Um, Her adult son was living in the property that wasn't paying rent, and she was just eating the mortgage every single month because she couldn't evict her own son. I offered to buy the property from her to help her out. She said, "Thank you so much." Got it under contract, and then 2 months later, she had her lawyer send me a letter saying that she wanted out, either because her son had convinced her not to throw his butt out in the street, or someone came along and offered her more money. And I had the choice to either fight her in court to make me $25,000 or let her out of the contract and eat the $20,000 that I had invested in marketing and operations to get to that first contract. I chose to let her out of the contract and I lost the money. And that's when I decided I wanted to own things as opposed to more transacting real estate. That was just my personal journey. I didn't feel good about forcing her through. So that's when I got into ownership and I started looking at multifamily. I think that single family rentals can be exceptionally lucrative for long-term rents. Only issue is you need $2,000 to $3,000 a month of rents for most single family rental properties for them to cash flow by themselves. And your ideal strategy in that moment is then selling that property to that tenant eventually. That's what you're hoping for in that property. And so that usually means you're trying to get into a really highly appreciating, higher cost neighborhood that everyone and their mother's trying to move into for good schools that people can't afford to buy into. So they rent from you and they stay there for 15 years. And then eventually they make enough money, they buy the house from you. I think that's fine. But for an appreciation play long term, because you can definitely make a ton of cash there. But I valued cash flow earlier on. So that put me into 2 to 4 unit buildings. And that's what put me into St. Louis. So I was looking at markets in St. Louis, and part of town that I really wanted to invest in was really highly populated by multifamily. In fact, I'll show you here. This is actually my zip code. It's one of the markets I invest in. This zip code right here, 63118. When you click asset type for this zip code, and you check out the map, almost 50% of the market in this area is 2, 3, and 4 unit buildings. So from earlier, talking about why it's valuable to fish in a stocked lake, if I want 2, 3, and 4 unit buildings, there is no shortage of them there. So that really stood out to me. So I wanted to have a lot of opportunity to acquire a large portfolio. Then I started looking at deals in this part of town, get an idea of what they would rent for. And I'm like, for example, I am going to put offers out on another 4 unit in St. Louis this week. So that got me into looking at these 4 units for cash flow and prioritizing things that have growing rents. Like for example, 2-bedroom rents keep growing here. So I look for 2-bedroom units. I'll look for properties that are going to be below the median. So like for example, in this area, the median house price and appreciation is so I don't even know. I don't have to remember those things because I have BrightInvestor. It's about 225. Most of my properties that I buy are right around between 240 and 270. Right in this region. Makes a ton of sense. They cash flow well. And then I use that to buy more properties before I got invited to learn more about commercial multifamily, which is what I do now in addition to my 4 unit multifamily. It's a whole different animal, but anything where I can own a large number of units collectively is what I'm interested in. So that means I buy a 4 unit and I buy a 200 unit, and I buy a 4 unit and I buy a 150 unit, and I buy a 4 unit and I buy a 200 unit. basically using to feed off each other for different reasons. Big commercial stuff for tax savings, and the small multifamily stuff to boost short-term cash flow, and then they feed off each other to keep growing the portfolio. A little bit longer answer, but that's the truth.
No, I mean that's really interesting, especially the part where that you said about single family homes like needing rents above 2,000 to really be able to like cash flow even a little bit. Like I've been looking in Texas, and I've looked in like, 3 different markets, and like the closest I got to cash flowing was actually on a duplex, but it wasn't in it wasn't in like, it was in an okay area. It wasn't like horrible, but it wasn't like good schools, family oriented thing. And so I definitely like with the the specific Texas specific markets that I've been looking at, I can definitely see how that would be the case. And I've kind of lost I've lost faith in the single family approach a little bit as a result. But I also wanted to ask you, like, what is your like I guess obviously it would be great to the ideal tenant, I think, is families. They're going to take better care of your home. They're going to treat it with more respect. Maybe, they have more stable jobs, but like, what is the like balance, do you think, between kind of going for that ideal tenant situation versus like, moving to an area that's like going to attract more variety in your tenants, and that isn't as good as like, it doesn't have like a 7 school district or a 7 or 8 school district, but it has like a maybe like a 3 or a 4, and it's a lower area. So like what is the balance that you, and what weights do you put toward each of those things in order to kind of get the right balance?
Yeah. So pretty much what I'm looking for is I'm looking for as many green flags as possible. So in the absence of as many red flags. So for example, if I look at this part of town where I'm investing, where I have property, I like schools, you're gonna see the schools are okay. They're 2s, 4s, 2s, 4s, 3s, 2s, and a 5 and a 5. They're fine. And like one decent school up there. They're okay. Now, the thing is, we have to target who our kind of end clientele is. So when I'm buying a single family house, if my cash flow is only going to be like $200 a month because the rents are super low compared to the price I'm paying, then my appreciation better be off the charts. But if I'm not in a super high appreciating area and my cash flow is low and like the incomes aren't growing fast enough, that for me makes no sense. I need to have one of those 3 things, or ideally 2 of those 3 things, working in my favor to make that deal happen. Because as incomes grow, people can afford bigger, nicer houses, people can afford to cash me out, and they can afford more rents. And so if I have an area like this where I can see, hey, home appreciation is going up pretty quickly at 10% per year, but the schools are only okay, but I'm looking at multifamily, well, for me, that's fine because more family-based tenants aren't going to be living in more duplexes, generally speaking, and those that demographic that's going to be my duplexes or fourplexes don't care as much about the school rankings. So for me, getting into a spot where the crime is okay, the appreciation is solid, the population growth is okay, and the income is growing, and where the rents and the purchase price make a lot of sense, is fine for me because I'm thinking about who I'm trying to rent to in this area for that type of thing. So pretty much as I go through this sidebar, I'm looking at, is appreciation a thumbs up or a thumbs down? And then if I have more thumbs up than thumbs down for an area and for a property I'm looking at, I'll pull the trigger.
What if appreciation is high over the last, like, say, 4 years or so, but the population has actually been declining? Because I've seen that in a couple of markets.
Yeah, that's when I do income. That's when I do income. So if you see population is actually declining, but appreciation is going up, you have to check income. Income, a declining population but a growing income is a sign of gentrification. That means that you have lower income folks moving away and higher income folks moving in, which is forcing home prices to go up. And so even though fewer people, or there is a net decline in the number of people living there, people who are living there are driving development and they're driving in gentrification because of their incomes and their home prices, which means we're more likely to see better schools come in and we're more likely to see higher income facing franchises like Starbucks and Targets come to that area. So I'm okay with a slightly declining population if the income is also like skyrocketing in like direct inverse for it. But if I go to income and it's like relatively flat or just growing like by a few percentage points and the population is going down, no way. Absolutely not. Because there's not demand there.
Yeah. And I think on BrightInvestor, I think the income stats only go up to like 2021 or 2022, right? Is there like a way to get that more current?
Yeah, so the U.S. Census releases that on an annual basis for the income trends, and so we have income for 2023 coming out, I think, in about 2 weeks, I believe, coming out straight from the hot off the presses from the census. So that will be coming in directly. The big thing that I would recommend looking for is trend over time and looking at the percentage growth. So we'll have that here soon. For it, we have up to 2022, maybe 2023 in some areas. Like for appreciation, jobs, rent, all of that's updated to as of this month. Some of the other things are a little bit dependent on the U.S. Census. So what I'll look for is generally the trend line, and my rule of thumb is 15%. So I'm looking to see has this area grown in income over the last 5 years by more than 15%? If the answer to that is yes, then for me that is a high income growth area, and it's something that I'm going to be interested in. If it's lower than that, I think it's too risky.
Yeah, because I think a lot of like it's also kind of weird because I feel like since 2020, just all of the all of the metrics are just like changed so radically compared to like historical norms. So it's also like, do you trust do you trust what you're seeing going back to 2020, or should you rely more on a trend line that's precedes 2020 that may have gotten a little bit wilder?
Yeah.
So
that's why I typically like to expand my time range. So like this is why, right? So looking at, hey, back in the early 2010s, home income here was like, you know what, pretty low, pretty low, pretty low. 2017 hit, and between 2017 we went from 30,000 to about 42,000. So what I'm looking at is, was this area growing before COVID hit? And the answer to that is yes. This area was growing before COVID ever got there, and the trend line started continuing. That's also the same reason that I like looking out at a wide range for things like appreciation over time as well. Like, hey, before 2020 hit for home values, was this area already going up in value? The answer to that was yes. It was already on a deposit. If we go back to, 2020, this was March. The area was already trending up. It had some declines. It was trending up over time. And then since 2020, this area has continued to improve month over month as we've grown. So I absolutely recommend looking over a wide period of time. That's why when you use BrightInvestor, it defaults to like a 5 or 10-year period, so you can see what was happening before then. You guys want to see an example of a pump and dump scheme? I'll show you one, which is what you don't want to be involved in. Evansville, Indiana. Appreciation. City by zip code. This is an example of what you don't want. And I bully Evansville, Indiana for this because they deserve it. That's what you don't want. Pretty much before 2020 hit, home prices were not trending up. In fact, they were kind of trending down. There was no actual substantial growth over time in this period. Then we got the pandemic, and everyone got super excited about real estate. They're like, wow, we're going to make a ton of money. Oh my gosh, look at this. We're crushing. Super big growth. And then interest rates started coming down. And that's not great. Boom. So this is why I look for things like this to get an idea of what was happening before this period in time.
I've seen a lot of charts that look like that.
Yeah. Yep. And that's why I'll look at individual zip codes and say, hey, what cities like this? Okay, great. That's what I'm looking for. The more consistent it was over time, the better it is for us, right? And if you're going to buy somewhere that had a pretty big decline, then you need to be buying well below the median to insulate yourself from those pressures. All right, guys. I want to say thank you all for being here. Actually, I have a meeting with Brittany one-on-one for one of our one-on-one sessions. So I'm going to make sure we give her that, respect her time. So, guys, thank you so much for being here for this office hour session. Hope it was valuable. If you have any questions, comments, concerns, or need help, please reach out, and I will see you guys potentially next Wednesday or Saturday as you need help on deals, markets, and just overall BrightInvestor support. If you have people that you think might get value out of BrightInvestor, I highly recommend bringing into a session like this and let them see for themselves everything that we do here. And I would love to, hear you guys, any comments you have about timing or things you'd love to see discussed at these meetings for the future.
Thanks, Donato.
You got it. Absolutely. Brittany, I'm going to hop on our one-on-one Zoom right after this.
Okay, sounds good.
Perfect. All right, everyone. Thank you so much for being here. We'll see you next time.